Good evening, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully you guys had a very good day on Friday and are starting off to a very nice weekend as well. Now, in Friday's markets, guys, well, the SPY and the QQQ ending red on the day, and that is in spite of some fairly bullish news that came out in the early hours of the morning. Now, of course, all news is going to surround the trade deals and possible trade negotiations, and Friday's news was no different, with President Trump suggesting a 80% cut to China tariffs overall, rather from 145 down to 80%, leading into Scott Bessent's meeting with Chinese officials over the course of the weekend. This was posted on Truth Social, where Trump was saying that this should possibly be an 80% tariff on China. Seems right, but it's up to Scott B. Speaking about Scott B, he was in China over the course of the weekend, and where we have this headline here, US-China tariff talks continue all the way until Sunday, which is what some officials have told the Associated Press. There was no immediate indication whether progress was made on Saturday during the meeting, over 10 hours between Scott Bessent and Chinese Vice Premier He Lifeng. Now, we know that the market is desperately anticipating some of these China negotiations to bear fruit because it is the largest trade-affected partner right now between these negotiations between the US and China overall, and seems to be the largest impact overall on market headlines. I'll remind you, on Thursday, we got a nice new framework for a deal between the United States and the UK, and the hope and the premise is for more deals to come onto the table in the next coming weeks. Now, all of this has to be counterbalanced with our possible recession timeline, which pretty much looks something like this, to where most of the last shipments from China to the US are coming in within the next few days and few weeks, and there it's going to be a battle between whether or not companies have built up sufficient inventory during Q1. Typically, companies are sitting about 30 to 90 days worth of inventory. Will that inventory be depleted before we start seeing empty shelves? That is the trillion-dollar question at the moment. And if ever it does happen, in terms of the empty shelves, that is going to be a narrative that the media starts to run with, right? Layoffs in transportation workers, dock workers, blue-collar workers, etc., and whether or not we can get some trade deals done during that time, which is going to be a positive news catalyst for the markets. So right now, we have a tale of two narratives. One in which we see a dwindling supply chain and dwindling of inventories, which could lead to empty shelves and possible layoffs. And the other one, which is trade negotiations and trade deals, which the market is going to like. These two narratives will be battling each other over the course of the next 2 to 4 weeks. So that is what you should focus your analysis on if you are trying to follow the macro headlines. So in today's video, guys, we have a few very nice things to cover together. Number one, we're going to be going over some of the earnings from last week, which we did not cover because we did not have the time. Those three earnings that I'm going to cover today are going to be Affirm, which had their earnings on Thursday, Mercado Libre, which mistakenly is here on the Thursday, but they had their earnings on Wednesday, and I'll be covering one that's not here, but that has had a bit of retail interest in terms of the last few quarters, and that is going to be Texas Roadhouse. So we'll cover three earnings today. Thereafter, we will do our major technical analysis in terms of the SPY, the QQQ, and all our major indexes, see how they closed on the week, and thereafter do the same thing for our big tech names, see whether or not some or all of these big tech names on this list are still in decent buying opportunities, which ones are looking better than others. And lastly, to wrap it all off, we were going to take a look at my portfolio for a few of the trades made last week and what I have into next week as well. Just a quick little glimpse into that from our Discord. We actually went perfect on the week. All of our wheel trades were absolutely perfect, whether we were targeting earnings or just the regular wheel strategy that I show you guys on the channel every single Sunday for those top 5 options videos in the future, in the preview on Sunday. So we'll be going over all of that at the end of today's video. So it should be a very fun one, guys. And as always, I know the videos are long. If ever you want to jump to a specific section, feel free. The links are down below in the description of the video. So let's get into it, shall we? The SPY down about 0.13, the Q's down 0.07, relatively flat day of trading on the Friday session overall. Take a look at your heat map right here. You will see that even better, to where some sectors were advancing, such as real estate and energy. A lot of tech was mixed on the day. Financials had a somewhat decent day. Healthcare continues to be a major lagging component of the S&P 500, just cannot seem to keep it up overall. And consumer defensives also struggling to continue their bullish breakouts towards all-time highs. A lot of this sector was very popular about 4 weeks ago when we were going through maximum fear, maximum uncertainty surrounding the tariffs, and has somewhat since been muted ever since. So that is your heat map for the day on Friday. In terms of where we stand on that one-day relative, you can see just how mixed of a day it was overall. Healthcare, defenses, and communication services to the downside, but to the upside, we had some nice jumps here in energy, basic materials, real estate, consumer cyclicals, and utility technology largely staying muted in the middle. Where do we stand on the 1 week relative, guys? Well, we know that last week was a week of a whole bunch of doing nothing. The SPY pretty much in a sideways trading range, and the QQQs, although we closed near the highs, largely really didn't do that much overall, which is why your 1 week relative looks something like this. Healthcare, communication services down on the week, defensives down as well with real estate. To the upside, not many phenomenal gains. Industrial, cyclicals, energy, and basic materials. Technology really flat there and right in the middle. But over the course of the last 1 month, we know we've had an incredible bounce in the markets. Most of all your major sectors are in the green, except for healthcare, which, as I've been saying, has been described as a very large lagging sector, especially because of the sheer weight that it has in the S&P 500. You really need this one to come back around to Team Bull if you want to see the S&P be able to break out of some of its resistance ranges that it's currently facing right now. So before we get into more technical analysis, guys, let us dive into some earnings. So we're going to start off with one that I don't cover much on the channel, but I do keep a close eye on, and that's going to be buy now, pay later service, Affirm. Now, there are there's a thesis going around right now. Well, it's not really a thesis. It's kind of a consensus right now among analysts that Affirm could be somewhat better insulated than other companies against possible economic downturn as consumers start using the service more in terms of being able to buy stuff now and pay for them overall at a later date. Affirm makes a lot of its money through merchant deals and merchant agreements, and also selling some of the loans that it gets in the open market as well. It's a fee-based structure overall. So let's get into some of the numbers, shall we? Affirm actually coming down on the Friday session, 14.5%, but that was not because they had bad numbers. They actually had very good numbers overall, but the stock is known to trade in a very volatile fashion. Take a look at the EPS. They beat EPS by 258%. I mean, when you're coming off zero, it's not really hard to do. They reported a standardized EPS of just about a penny per share and a nice little tiny revenue beat by 0.02%. So unfortunately, those numbers were not enough to generate some bullish action in terms of the stock price on Friday. However, the numbers were quite good when you dig a bit deeper, and that's what we're going to do right now. So take a look right here at your snapshot. You'll see revenue up 36% year over year. Customers were up 23% year over year to 22 million. That is very strong. Affirm is the leading buy now, pay later service in the industry, and it's really not even close. Merchants, the amount of merchants they do business with, 358,000 merchants, 23% year-over-year bump, and a nice little bump on operating income as well. I'll remind you, the operating margins were negative for a long time for Affirm, but now are oscillating towards positive territory. This is what I've been waiting for to invest more heavily in this company. They've been projecting for net margin profitability since a long time now, but haven't really achieved their goal. However, in the most recent few quarters, they are actually bringing in positive net income to the bottom line, and that's when you're looking for the good old EPS flip from negative to positive. This is really when I want to take a deeper look at a lot of these companies. Now, some bullish news as well. They secured a very large merchant overall in the recent days, and this was Costco. Costco getting into a deal with Affirm. It was not advertised very much, but that is a very big deal for Affirm. Now, Affirm lost a big deal as well to Klarna in the name of Costco. And when justifying why Affirm refused to bid for that Walmart deal, they said it was not much of an economic benefit to them. Apparently, when they ran the numbers, it just did not make sense to maintain the structure of that deal. So they were very happy to offload it to Klarna overall. Instead, Costco probably being a better deal than Walmart, just because the average ticket price in terms of sales and in terms of items is larger at Costco. And that is exactly what Affirm wants. Let's get into some of the numbers, shall we? Affirm drops 8% on weaker than expected guidance for the current quarter. Well, now it's actually closer to 15%, but at the time the article was written, that's what it was in the pre-market. So here we go. They gave a revenue forecast for the current quarter that trailed analyst estimates, even as profit for the prior quarter was better than expected, and as a result, the stock fell. Affirm reported GMV, gross merchandise volume, of 8.6 billion, topping the estimate of 8.2 billion, which was very good. GMV actually increased 36% year over year. Fantastic. Revenue as well was up 36% year over year. Extremely strong. Company growing that top line in a very aggressive fashion. And the bottom line profit margin metric, revenue less transaction costs, was at 4.1%, which was slightly above its long-term target range of 3 to 4%. This is what you want to see, the company improving all metrics of the operating and bottom line margins. Now, adjusted operating margin was 22%, compared with the estimate of 21.6%, and Affirm reported a net income of $2.8 million, which is a fraction of a percent in terms of net income margins. I will remind you that Affirm as a business does have very good overall gross margins. Their cost of goods sold is not very high, right? It's a software company for the most part. You can see that here, gross margins always in the mid 80% range, and they've maintained that for the last 7 quarters. The struggle was really getting operating margins from negative to positive, which they've done now, 20% in excess, and now even net margins are starting to curl up higher, which is really what you want to see when you're targeting these fast-growing companies. Moving on further, for the current quarter, Affirm is guiding for revenue of $830 million, which was below the analyst estimate of $841. That was a major reason for the decline in the share price on Friday. Affirm's business is closely tied to consumer spending, as its online loan offering has become popular with sellers of electronics, apparel, and travel. They're partnered with so many big clients. Right now, we're seeing credit outcomes that are very in line with expectations, said the CFO. We haven't seen any signs of stress on the consumer side. And I'll play you guys a clip from the CEO in just a few short moments. We're going to get his insights into the consumer, which aspects of the business are lagging behind, if any, and what does he currently see for the expected year. Affirm is forecasting fourth quarter GMV of $955 billion, which is up from the analyst estimate of 9.2. So another good portion of guidance there for GMV, but unfortunately not translating into enough revenue for Wall Street. Adjusted operating margin is expected between 23 and 25%. That would be the best ever compared to the 23.8% street estimate. Affirm reiterated its commitment to achieving profitability on a GAAP basis by the end of its fiscal fourth quarter in 2025 this year. Affirm's active customer base increased to 22 million, which was 2 million new users in terms of overall platform components. The Affirm Card, another fast-growing segment of their business, which is the company's big bet for driving greater usage overall, saw GMV rise 115% from a year earlier, and the number of active cardholders more than doubled. That's exactly what you want to see, guys. The company's getting more and more attractive, even though it's still the leader in its industry. They are grabbing more and more market share. The company's partnership with Apple, Amazon, and Shopify continue to drive momentum. In June, Affirm and Apple announced plans for US Apple Pay users on iPhones and iPads to be able to apply for loans directly through Affirm. Very big deal for Affirm, in my humble opinion, especially with the amount of Apple devices in circulation right now, which is over 3 billion. The quarter saw a notable rise in 0% interest loans, a strategy in which merchants and sometimes manufacturers subsidize borrowing costs to drive sales. That marked a 44% increase from a year earlier. I'm sure you guys have seen these 0% loan offers from Affirm and wonder how they make money. Well, very simply, the merchant is going to pay the interest on the product. In the clip from the CEO, he'll explain a bit more why that happens, how it happens, and why companies are driving more and more for these types of deals, because it generates more sales and it brings consumers into their ecosystem. Let's have a listen to the Affirm CEO, what he has to say about consumers and these 0% interest loans, which is going to be a very big revenue driver growth for the company, and they're the pioneers of that. Let's have a listen, shall we?
What is your sense just of the strength of the consumer right now?
You know, it's pretty good. I think there's a real inconsistency in the vibe where people are stressed out about the economy, yet they're shopping, they're buying, and they're paying their bills. At least they're paying their bills back to us on time. Our credit print actually from last quarter, and you can see it every month because a lot of our credit results are reported every month. It's really solid, very, very consistent with our expectations, not rising.
That's really interesting. We heard from Bank of America Institute this morning, and they said the same thing based on all the data they see from their customers. Do you think that this is the consumer worrying about things, but they're not changing their behavior at this point? I mean, our guest this morning tied it back to the idea that there's still a very strong jobs market and that wages continue to rise.
That's exactly right. The only metric that I really care about running a credit business is employment. If employment is strong, everything's going to be just fine. And employment has been really strong. The last job print was fantastic from my point of view anyway. And so I don't see anything in the water yet that makes me worry.
Is there any shift in terms of the kind of purchases that people are making, the amount of money that they're spending? Are they are they upgrading from a 75-inch TV to an 85-inch TV, or are they downgrading from an 85-inch TV to a 65-inch? I mean, to the extent that that means anything.
You know, we delve into this data every single day, and the short answer is we saw really strong growth across every category. Yesterday, somebody asked me on an earnings call, so where did you see, particular strength? And I was scrambling through numbers, like, everywhere. The number from this morning, I think you quoted 1% increase in credit card and debit card spend, 36% increase in Affirm spend. There's some difference here.
But it's also that you're stealing market share. You're
absolutely. We are
base.
We are helping people understand that not paying interest, revolving interest excessively is a good thing. And yes, we're taking share from credit cards.
So there you go, taking share from credit cards as well. Now let's have a look into why he does those 0% loans. Let's have a listen.
Leaning into 0% promotions where they are essentially paying the interest that consumers would be otherwise paying. And so it's a true, it's a great value. You're paying for something that is quite expensive over time, but not paying any interest on it at all. And even if you are late by a day or miss a payment, you're still not paying any penalties. That was a huge driver of growth for us, both last quarter and the one we just reported. Many merchants have reached out to us and said that really worked for us over the holiday season. Let's do it again. That's a fair amount of the growth that we saw comes from that. Certainly not my place to comment on competitors, but we seem to be growing somewhere between 50% and 100% faster than just about anybody else in the industry. So I think we're doing really well.
There you go. Have it from the CEO of Affirm himself. Let's have a look at some of the earnings slides, and then I'll give you my take on whether or not this company is a buy or not. So there's your increase in GMV, so very, very solid, increase in active consumers and transactions per active. My bad, guys. Apparently the video was playing in the background. So as I was saying, GMV, a little uptick here. Active consumers, transaction per consumer as well. Also up and to the right. Revenue, very strong, 36% growth. Let's move on, shall we? There's your increase over time in GMV, which shows the company is growing well. At least they have been in the last 2 years worth of business. Direct-to-consumer GMV is also doing good, whether you measure on the Affirm marketplace or the brand new Affirm card that's been in place for a year worth of time now. Affirm card active users is also very, very, very strong to the upside. The card attach rate and the card active consumers both moving up and to the right. Very good. If we move on further here, you can see they have a partnership across a wide range of category. General merchandise is still the best performing category for them, but shout out to fashion and beauty, travel and ticketing, and electronics, which seem to be very fast paced growing in terms of for purchases through and use of Affirm overall. Active consumers, as you can see, very, very, very high as well. And that transaction per active consumer is moving marginally higher as well. Both things that you want to see move together at the same time. Quarterly transactions, 94% repeat customers. If you've used their product once, you have a very strong chance of coming back. I've used their services many times before as well, especially when they offer those 0% juicy loans, if you can qualify for them, of course. Active merchants, 23% compound annual growth rate over time. As we start to hit more and more and more merchants that are partnering with Affirm, it gives them leader industry status, and it's not even close at this current stage. Special shout out to Afterpay and Klarna. They're two closest competitors, but in all reality, they're not really close at all. There's another graph for revenue, interest income, and loans held for investment composition. Their interest income composition is moving up and to the right, which is very, very strong overall. And the composition of average loans held for investment is also a relatively very high quality for the type of business that they operate overall. Now, transaction costs have been on the rise. However, percentage of GMV has remained roughly flat, as illustrated by this yellow line right there. So that is very, very solid. The company's benefiting from operational leverage, whereby their revenue is increasing, but their expenses as a portion of revenue is either staying the same or overall going down. That is very, very strong. And you can see that best here when we look at operating expenses, whereby there are several lines of businesses in terms of their operating expenses divisions. Well, as a percentage of revenue, the focus should be on this yellow line right here. As a percentage of revenue, you should be looking at this coming down. And that's exactly what's happening, which is why their operating margins have been coming a lot better and better over time. And that's translating now into positive bottom line net margins. Now, of course, being a company in the credit business, you always have to take a look at their delinquency rates. As you can see here, their monthly delinquencies over 30-day time periods, you can see is actually hovering in or around here the 3% or 2.5% range, which is not so bad. It's roughly on par with several of their prior fiscal years overall. If you were to remove Peloton from that, it gets slightly even marginally better overall. And when we take a look here, you can see that they're, as of 3 months, 30 days delinquent, you're sitting at about 2.4%. 60 days is 1.5, and 90 plus days delinquent limit is 0.6. So apparently people may miss one payment, but do not miss 2 or 3. So your average rate overall is in the 1.5% range. If you take a look at the 30-day delinquency performance against select consumer lenders, you can see that Affirm is the black line on the bottom right here and doing fairly better, even despite the fact that it does have some delinquent customers when you compare it against some of their sector peers and also some other banks that they compare against. You can see here that their delinquency rate overall is right around the 2% mark, slightly above 2%. So very good overall. I would not say that the delinquency criteria is a problem for them overall. Now, in terms of valuation, so I did this one a bit lengthy because it's the first time I really cover it on the channel for you guys. In terms of the valuation right now, at $46 after their earnings, after a 14% drop, is the company a good value proposition for possibly an upside bet as they scale into this brand new segment of the market that they are a large component of creating the entire niche for the market overall. They're getting better and better merchant deals overall. They're scaling their consumer base. Their GMV is going higher. Their revenue is scaling quite nicely as well, 19% per year. And EPS is growing and now turning positive. This is when I love watching a company, right? If you take a look at their EPS and their price to earnings, right, it's not going to make sense because their EPS is coming off 0. So we kind of have to forget these two metrics. They're not going to make sense when we're looking at doing an earnings analysis because the company was negative and now coming into positive. So if you were to take 2025, it doesn't really make sense. But if the 2026 is a baseline, when it normalizes, their price to earnings on a 2026 basis is 55, and their PEG ratio with this earnings growth rate, which is the same, remains at about 0.71, which is pretty good. Now, a more streamlined metric could be something like a forward price to sales, and at under a 5 for the line of business that they're in, that's actually quite good. This company has traded as high as 6, 7, 8 price to sales at certain moments in time throughout its history. At 4.71, I would be able to argue that you are finding this one at a discount. And if you were to just take a straight line analysis for this one, giving it a long-term price to sales from the street of about 5, well, what we can do here to generate a forecast for price is go to their 2028 sales estimate, which is going to be about 6.36 billion. And then you just times it straight line value with the price to sales. So 6.36 times about a 5 multiple on price to sales. That'll be about a $32 billion market cap. And right now they're sitting about 15. So you'd be looking at a 2x roughly over the next 4 years, which is about a 20-25% compound annual growth rate, which is pretty good. So can the stock expand here into the 100 to 110 range? Yes, absolutely. But if Wall Street lets this multiple expand, or if people start getting extra bullish on the stock, you can see that happen a lot sooner. So I do like this one. I think there's a lot of meat on the bone for this stock as well. And you may even see this one as part of my portfolio, maybe even for some leap call contracts. I'll be exploring those coming into the next week with this nice little retest into the support range, 46 down to roughly $40. That's everything I had on Affirm. Spent a bit more time on it, but it did definitely warrant it. Now, company number 2 is going to be an extremely solid stock, one that's been in my long-term portfolio for years and years now, and it's going to be Mercado Libre. So taking a look at Mercado Libre right here, we can see that after their earnings, the company shot up 10% to absolute brand new all-time highs, $2,450. Now, the goal here is going to be to determine, even though the company is at an all-time high, is it still a good buy proposition? And is it still as solid of a company as when I bought it all the way back here in the late stages of 2019? And the answer is yes. Very strong company. Let's have a look, shall we? Their EPS beat by 18% and their revenue beat by 8%. These are fantastically large beats on such a solid company. I'll remind you what Mercado Libre does. They're somewhat referred to as the Amazon of Latin America, but they do not only have an e-commerce business, they also have a fintech and lending arm, which is extremely powerful in its own respective market. Let's have a look at some of these earnings results, shall we? So Mercado Libre stock rallies to record high after a big Q1 beat, and big indeed it was. Earnings from Mercado Libre in its March quarter grew 44% year over year. That's net earnings in terms of their EPS per share. Fantastic growth there. Revenue increased 37% year over year. The company is just churning money out there. Mercado Libre operates as an e-commerce platform across 18 countries in Latin America. Its largest markets are Brazil, Mexico, and Argentina, where it was founded. Argentina performed exceptionally well, with last year's recovery in demand strengthening even further. GMV sold in Argentina increased 125% year over year, the company said, compared with 20% growth in Brazil and 26% growth in Mexico. These are phenomenal phenomenal double and triple digit growth, guys, in GMV. You do not see that very often. Mercado Libre is still growing. And are they currently at scale right now, or can they get even more? Take a look down here in the article and I'll let you guys know. Total GMV volume grows 17% year over year. Total payment volume for the fintech operations grew 43%. GMV for the e-commerce brand is 13.3 billion. It's small compared to Amazon, but wait till you see the total addressable market. The payment arm of the business, right there, Mercado Libre Pago, essentially, a fintech, 58.3 billion in payment volume. That is massive, guys. Taking share from physical stores, which still account for approximately 85% of retail spend in Latin America, is one of the largest of these opportunities. So have they hit their TAM yet? Not even close. Still 85% of retail spend is done in store. We have less than 5% share of the region's total retail market. Insane, right? The total addressable market for this company is huge. Continuing to invest in our value proposition to make the online buying experience more attractive than offline is the best way to increase our share. Very bullish comments from Mercado Libre overall. Let's take a look at this graph, which shows the quarterly revenue by segment. Dark blue is going to be the e-commerce segment of the business, and the light gray is going to be the fintech revenue. As you can see, they continuously expand both lines of business overall. Q4 is usually their biggest quarter, and then we have a slight drop in Q1, and we've been able to see that now over the past 2 years, which is largely similar to Amazon's business structure quarter over quarter as well. Let's take a look at some of their highlights in terms of the tariffs, guys. So Mercado Libre CEO says that the US-China trade war is a big opportunity for Latin America, saying that possibly people will shift their production from China over to Mexico. And who does that advantage? It definitely advantages Mercado Libre overall. More distribution, more fulfillment, and everything in between. So that is what this article says. This came out pretty much, at the end of the month of April. So now this will be front and center for the company, at least in the next 6 to 9 months. So that there's possibly a secular trend of shifting production from China to Latin America, and Mercado Libre definitely stands to benefit from that. Let's take a look at some of their earnings slides, shall we? So in terms of their operational and financial headlines, GMV 17%, we already said that. Items sold, 28% year over year. Total payment volume, we covered that, 43%. Credit portfolio has seen an increase of 75% year over year as well. Their net income as well came in at 8.3% net margin. Now, this is roughly standard for Mercado Libre. They were scaling from very small, low single digits, 2-3%, now all the way up to almost 10% net margins, which is very good for the company overall. Let's take a look at some other things here. Unique active buyers now stands at 66.6 million unique active buyers on their e-commerce platform, and that is only going to grow as they gain more and more share online versus the offline market right now, which is 85% of all sales, right? This is like finding Amazon in its early years when it started taking over more and more shares of that physical retail spend, right? As you can see, items sold across most countries is moving marginally higher, looking very good there. Every quarter, they put in double-digit growth or very close. Marketplace highlights, they're doing same and next day shipments for 143 million products per quarter, which is fantastic. 50% of shipments are delivered within the same or next day. And if you guys have ever been to Latin America, you know how hard this is. The infrastructure is not the same as it is in the United States or several other Western countries. Last mile delivery is often done by moped or motorcycle or scooter, right? And they've been able to scale that from a 20% of all shipments up to 50% at the current time or the last few years that I've been following them. Very, very, very strong overall. Items sold per unique buyer remains at a very strong 7 items. I expect that to start either being maintained or scaling higher. Fintech services highlights, guys, monthly active users, 64.3 million. This is kind of like a service like PayPal, but they include credit cards, they include peer-to-peer transfers, and several other things that you would expect from any fintech company. That is 31% year-over-year growth. Of course, the law of large numbers is going to catch up to them. That's why it's been declining, but still, guys, a lot of monthly active users to still be found in those overall assets under management. You're now sitting at over $1 trillion pretty much, which is extremely strong. Sorry, This is about $110 billion, excuse me. I was off by a comma, and a very solid credit portfolio overall for the company. Fintech services highlights net interest margin after losses is still at a very strong double-digit growth rate. So when we take a look at why this matters, net interest margin after losses, it's since the credit worthiness of some of their clients in Latin America is not the best, as we'll see from a few slides down below here, Fintech Services highlights past dues 15 to 90 and over 90. From 15 to 90, it's about 8.2% of all clients, and over 90 is 18%. Now, the goal here is to determine, do they bring in enough money from this division to cover any excess losses? And that they do. And even when Fitch here did a credit rating upgrade on them just last year, that is exactly what they noted as well, right? Although saying that non-performing loans are relatively high, below 90 days and above 90 days, MELI must maintain high profitability to cover credit losses. This is the same as any financial institution. In the last 2 years, net interest margin after losses averaged 34%, positively contributing to fintech take rates and overall margins. So it does make sense for them to continue to expand this business overall. Very, very strong. Nothing really bad to say about the company at all, guys. I mean, I'll save you the gist of everything from more slides overall, but just to let you guys know that the available cash and leverage stays very strong at this company overall. Debt is really not a problem for them. And we can see that when we take a look at their balance sheet. Very, very strong balance sheet overall, guys. As you can see, they do have some debt, but look at the amount of free cash flow they bring in per year and the amount of cash and cash equivalents that they're sitting on. So the company definitely does have a lot of operational leverage right there to continue on scaling. Taking a look at their future growth, EPS, sizable increase up and to the right here over the next 4 years. This is when they're going to hit arguably their most profitable segment of the business after scaling it from, losses now to net margin profitability. I expect this company to do well in the future. And revenue is just going to continue pumping up, guys. It is currently, well, as of last year, 20 billion. By 2028, you're going to be looking at a 2.5x revenue expected to be $50 billion. So this company, even though it's at the all-time highs, it has a lot of growth ahead of it. And you can clearly see that by the compound annual growth rate of both their revenue and EPS. So at their all-time highs, 24.50, guys. Is it still a good deal objectively? Well, I wish you guys would have asked me that question back here. Rhetorical question, right? I talked about Mercado Libre a few times on the channel in or around these lows. I talked about it several times last year. A few of you remember in the $1,500 mark where even I was adding more shares to my long-term portfolio, but I digress. Right here, right now, is it a good deal or should we be waiting for a pullback? Well, maybe it's both. Right now, their forward price to earnings sits at 50.69. And then if you divide that by their strong EPS growth rate, you get a 1.49 peg, which in the grand scheme of things, is not that bad. Who else trades at a 1.49 peg? I don't know. This company here that starts by Amazon and ends with Amazon trading at a 1.47 peg. So the valuations on a peg basis are fairly the same, right? Amazon has AWS and other things. This company has Mercado Libre Pago, their fintech arm. So, each company has somewhat of a diversification away from e-commerce alone. Forward price to sales sits at a 4.71, which is good considering the high amounts of growth that they have, well in excess of Amazon. Amazon sits at a 3, and a free cash yield of 4 is also quite good. So I do think that even here, Mercado Libre is a very decent proposition for some growth. However, if I were to see this company for the first time and want to participate, maybe that means establishing something like a 15 to 25% total position size, and then perhaps waiting for a dip if it were to come, or just embark on a DCA process every single 2 weeks with my paycheck if it's a company that I want to scale in over time, because we know that over the next 4 or 5 years, the company's future does look very bright and should have a very decent compound annual growth rate to go along with it. So that's everything I had for Mercado Libre, one of my favorite international stocks in the entire market. Now let's move into another somewhat fan favorite, which is going to be Texas Roadhouse. So Texas Roadhouse coming out with their earnings Thursday after the close, and the company was up 5% on the Friday session. Now this one I'm sure had surprised a lot of investors here that were confused as to how a steakhouse was having some of the best returns in the entire S&P 500 over the course of the past roughly 2 years at that point. And it all has to do with the value proposition of the company. If you've ever been to Texas Roadhouse, you know that although there are some fancier steakhouses that you can go to, Texas Roadhouse really does a good job of providing very decent quality quality for a very decent price point overall, which is why it has a lot of returning customers to it. And I myself, every time that I've been to Texas Roadhouse establishments, which unfortunately I can count on one hand because I'm in Canada, whenever I get the chance to go to one in the United States, I always don't mind going to Texas Roadhouse overall. Let's take a look at some of their numbers. Are they doing good? And how can tariffs potentially affect their business model? Well, let's have a look. In terms of their numbers were great. Comparable same-store sales were up 3.5% when measuring over the Q1 quarter of 2024. Revenue was up 9.6% year over year. Store week was also up 7.1%. Income from operations also positive as well. And the restaurant margins stay at a very cool 4.7%. And if you guys know anything about the restaurant business, that is not easy to do when you're facing cost inflation pressures from several different items, right? Either from your inventory and food or from labor costs as well. It's very tough to, kind of ride the fine line between not increasing your prices too much, because if you do that, you're going to lose a lot of customers, but also maintaining that value proposition that you're known for, right? So new store openings in the quarter was 8 total, 7 Texas Roadhouse and 1 Bubba's 33, as they do operate several different lines of business overall. And we're looking at about 77 million of capex as they continue expanding stores overall. But you do have some very nice dividend payouts here and some very nice share repurchases as well. Let's get into some of the earnings numbers directly, shall we? So in terms of the earnings numbers, we largely covered them already in terms of this quarter. But I wanted to show you guys, oh, I'm sorry, I didn't even show you that they actually had a decent quarter. They missed on EPS slightly, but they did beat on revenue overall. Now, some of the highlights of this have to do with some of their 2025 outlook. So here's some comments here overall by the CEO. We continue to consistently grow our business through new store development, which included the opening of our 50th Bubba's 33 restaurant this quarter. Additionally, we are committed to our proven capital allocation strategy of utilizing operating cash flow to fund our development pipeline, more stores essentially, maintain our existing restaurants, and pursue franchise acquisitions while also returning capital to our shareholders through the payment of quarterly dividends and share repurchases. And share repurchases, they definitely do. Not as crazy as like an Apple or a Google, but just to let you know that the company is thinking about its shareholders. It has at several points throughout its last 10 years of operations, repurchased shares on a very steady basis overall. Let's get back to those earnings and take a look at the outlook. So amidst the tariff headlines, what do we have to do here? Well, in the first 5 weeks of the second quarter, the comparable store sales increased 5%. That is very, very strong. In addition, the company implemented a price increase of approximately 1.4% in early April. I want you guys to keep this 1.4% in mind. It's going to matter when we go over the next few lines here. Commodity cost inflation. Now, here's the guidance in light of the tariffs overall, okay? Not their entire supply chain is affected by tariffs, but there is a portion of it, okay? So commodity cost inflation, talking about food, beef, etc., right, is approximately 4%, including the estimated impact of tariffs. They're expecting for 2025 positive comp restaurant sales growth, including the benefit of menu pricing actions such as this 1.4%. But you should be having an alarm bell in your head right now. They're only increasing prices by 1.4, but commodity cost inflation is 4%. Wage and other labor inflation is also 4 to 5%. So does that mean that they're taking it in the margins? The short answer is yes, but why are they willing to do that overall, guys, okay? I'll show you guys why they're willing to do that right now. So number one of the biggest impacts is going to be on seafood. They're the most imported portion of their basket. So they come from outside USMCA countries. Outside of seafood, there are no other significant components of the commodity basket that are purchased from outside North America. So that's going to be the largest driver to commodity cost inflation right there. Here's what one analyst had to ask them. I think you're also pricing below wage inflation. Was that the right interpretation? That seems like something you've historically priced for. So the analyst saying, you guys have done this before. And what is your take on that now? So here's what he had to say. Head of Investor Relations. Yeah, with 4 to 5% being our wage and other guidance, now within that 4 to 5%, the underlying wage pressure is probably about 3. But we do tend to price for structural inflation, meaning 2% is their target. It doesn't mean that we always price for it all at once. So if it's something that we're very careful on and very methodical in our pricing decisions, here's what the analyst had to say. Understood, and it seems to be working for you. So even though Texas Roadhouse is facing higher cost pressures and could take it in the margins, what they do not want to do is lose their top line revenue growth by off-putting too many customers by raising prices too much. So they still want to be a go-to restaurant for customers looking for a night out, possibly in this economy where we know that consumers are being very picky with their overall price, with their overall discretionary purchases, especially for restaurants, right? And when you ran this earnings, there's a lot of questions on that. When we put it through Grok, Grok says the emphasis is on conservative pricing to preserve the brand's value proposition, avoiding aggressive increases despite commodity pressures. And they do also plan to own around 30 new company-owned restaurants, which is about 20 to 25 Texas Roadhouses and about 7 new Bubba's locations. So that is everything I felt that was very relevant from Texas Roadhouse. Good guidance in terms of comp sales growth for 2025, but also not losing track of their value proposition with heightened increases in the cost side of the business. They are not going to put all of those costs on the consumer. They will absorb some of those in the margins, and they do have some margin absorption capacity overall, as their margins are not razor thin. They usually operate around, 7 to 9% net margins. So they do have a bit of room there. In terms of the valuation, here at 180, the company sold off a lot. We know everybody's been waiting for a discount on this stock, but now that we're kind of back above to the March and February levels right now at 180, is this a company, if you like it, that you could be adding to your portfolio and could be seeing some good growth in the future? Well, let's have a look right here, shall we? At 180, they have a forward price to earnings of 26.7. At 180 as well, that means they have a 2.72 peg, but the peg is not the best suited for this brand. Why? Because they're not growing EPS above 10%, so you can't usually look at it in terms of growth of earnings. What you'd kind of do is look at it on a forward price to sales, which you do for a lot of the restaurant industry overall, and that is currently standing at a 2.05, which is very good. When we look at the industry standard, you can see down here, restaurant and dining average price to sales is about a 3.69. So Texas Roadhouse does trade for under the industry average, which is what you're looking for when you're trying to do comparative analysis of a company versus its sector, right? And they're trading at a 12-month free cash yield of about 3.3%. It's not excessively high, but 3.3% is good. Now, if we allow this multiple to expand into the industry average and we were to take a 3, just because it's such a resilient business with a very loyal customer base and they have a very good value proposition, where can we maybe see this one in the next few years? Well, let's take a look at their 2027 sales. It's going to be $6.91 billion. So if we take $6.91 billion as the estimate for sales and give them a bit of multiple expansion to a 3, which should kind of be in line with the industry standard, even slightly under, you're looking at about a market cap of 20.73. Currently, the company is sitting at about a 12 billion market cap. So when you do the division right here, that means upside by 2027 of possibly all the way up to 72%. But you may say, yeah, but Will, you're expanding the multiple. And this is true. You can even do it with a similar multiple. Let's say they stay at 2.05. If they stay right here and they do not get any multiple expansion on price to sales, you're going to be looking at a 14% or a 14 billion market cap, which above the current market cap right now is roughly a 18% compound annual growth rate for the next 2 years. I think the answer is somewhere in the middle. All I'm here to say is this company can have some pretty good share appreciation, and I would not be surprised if for the next 12 months, the company does make its way back to its all-time high. Very decent restaurant to have in a portfolio if this is the type of stock that you like overall. And that's everything that I had for Texas Roadhouse and all of our company earnings. Hopefully you guys appreciated that. Now, that pretty much wraps it up for a lot of our biggest companies in terms of earnings. Next week, we do have some big ones. Special shout out to Monday. Monday is going to be a Wall Street Bets Day. Rigetti, ASTS, Archer. Then you got the SMR, NuScale, the small modular nuclear reactor plays. So, and then we have Oklo as well on the Tuesday, right? So a lot of very hype plays coming up, but no really huge companies to be had until the Thursday, which is going to be Baba, Walmart, John Deere, and other things like Applied Materials, and then Grand Theft Auto 6 maker Take-Two Interactive, right? So we're going to have some bigger names coming on the Thursday, but as you can see, we are winding down earnings season overall. Hopefully you guys have enjoyed all the earnings recaps that I've provided you with over the last roughly month and a half. Now, let's get into some charts, shall we? So let's wrap it all up, or start it off rather, with the SPY. So the SPY, as we can see from the daily chart right here, is a little bit confusing, right? We know that, yes, we're trying to close over and above the support range, but we're barely just doing it, right? We're still kind of trapped inside. We know the last few weeks of trading have been very good, but a lot of the emphasis in the next few weeks, guys, is going to be all about the trade deals. Over the course of this week, we do have some macro to pay attention to, which is largely going to be the CPI on the Tuesday event. And then on the Thursday session, we get some producer numbers as well and retail sales. Special emphasis is going to go on those retail sales because, as we can see, it's supposed to come in fairly weak here at only 0.1%. If this goes negative, you may see a little bit of a pain point in the markets as people start to focus more and more on this portion of the narrative, right? People pulling back on spending, possibly anticipating a recession. Other than that, on Friday, we also get the infamous, at this point now, Michigan Consumer Sentiment Survey, which was a pain point for the markets over the past 3 months overall. How that translates into price action, guys, it's going to be very volatile, and it's very tough to predict where these markets are going to go. We've had a tremendous rally off the bottom, but as I was saying in the intro, we have a battle of two narratives right now. Can we get more and more trade deals done before we possibly start seeing the early signs of dwindling spending, dwindling capex from corporations, and layoffs as well, which could translate into a recession? That is why I don't try to predict the direction of these markets. I'm not going to say this is the absolute bottom of this market cycle right now, and I'm not dare not say whether we move on to the all-time highs before experiencing more pain. We will take this one day at a time. How does that translate into trading activity? Very simple. If you're trying to go long, use a stop loss below your most recent daily lows. You know the bulls have a nice daily uptrend right now. Daily higher lows right now are about 555. If we're looking to position long into the next area of resistance, which is 585 to 575, this is pretty much your stop loss. Why? If you lose this, it's a daily downtrend. At that point, you're looking for weekly consolidation. Anything above 510, looking for a weekly higher low for possible further trend continuation. So do not get trapped without a stop loss, going for the absolute moonshot, thinking that the market is clear and free pretty much right now, because it's not. Trade with a stop loss and be fairly careful. But as of right now, the bulls maintain full control of both the weekly and daily timeframes. We'll keep a look at this one day at a time. And the same can be said about the QQQs right now as well, right? We know that the daily uptrend is in the bulls' favor, putting in a new high, coming into resistance very shortly, 495, roughly up to about 510. This entire area of previous support for the bulls, which is now going to be a bit of resistance for them too. The daily higher lows right now sit at 477. No real new breakouts of the high. So if you flush this early next week, you have to understand you are in a daily downtrend. Luckily, we have support below us, 480 down to 466. But if it gets pretty bad with some of the news headlines, daily downtrend, you should understand the bulls I'm going to be looking for a little bit of support down here, anything above 428.67, looking for a higher low for possible further trend continuation. So all in all, very easy. If you're trading long, trade with a stop loss. Target your most recent daily higher lows, because then you know the trend is still in your favor. If you lose it, then you know that you're going into a bit more weekly extended consolidation, so any long should be cut and possibly looking to be repositioned at a lower price. That being said, if you are a long-term investment, well, the goal has always been very, very clear, guys. In any market, you, every single paycheck, every 2 weeks, should be putting 10 to 15% of your earnings into your favorite high-quality companies or ETFs and investing for your future. The next 5, 10, 15, 20 years. I'll remind you, the S&P has been through so many different market cycles overall, and this one is no different. So definitely invest for your future, guys. No sense in hoarding cash right now, not 100% cash, waiting for a doomsday recession, guys. You're not too sure if you're going to get it, right? 10, 20%, a little bit more than that is fine. But if you want to take it after Warren Buffett, right? Even Warren Buffett, it's only about 25, 27% cash right now, not 70, 80, 90. He largely stays fully invested in the markets. Moving on to XLF financials right now. XLF also in a nice daily uptrend. So same analysis, right? Daily uptrend is very firm right now. Daily higher lows are set at 49, looking for expansion into the resistance range, 5150 down to 50, which is going to be your all-time high range of resistance. In the event you pull back and lose this area right here, 49, and open up the door for a daily downturn, you have nice support below, 4832 down to 4686. All of this big region down there, 200-day EMA is way below, and that would just be looking for weekly consolidation, right? Anything right now above 4512, looking for a higher low for possible further trend continuation. I myself, if I'm looking to write puts on financials, I'll be looking for a hard pullback into support and then trying to find some areas down below there on my favorite companies and financials. Moving on to healthcare right now, the biggest lag and biggest drag on both the Dow and the S&P. Well, healthcare right now still in the context of a sweeping daily downtrend overall, not looking very good, right? So the lower highs are set right now at about 135.62. Any bounce looking for a lower high into lower low, that is until the bulls prove it to us by getting a hard, heavy bounce and resetting this into a daily uptrend. As of right now, the bears full short-term control, and we are trending towards the lows. Not a very good weekly candle close, is it, right? Pay special attention to this whole area, 131, 130. Flush that, and unfortunately, you lose any attempt that the bulls had at a weekly uptrend and even any attempt at a tightening range. At that point, you're just going to be heading lower and lower into monthly consolidation. Head and shoulders, the prophecy has now been fulfilled, and we're going to be targeting the bottom end of this range right there, around the 125, 126, which has been support for the bulls for a very long time, talking about 2021. Very rarely does healthcare clip below its 50 EMA, but as you can see from this chart, right, whenever it does, it's usually a good buying opportunity if you are the type of person that likes to go shopping for healthcare companies that have been selling off from their all-time highs. Moving on to SMH right now, up 0.65% on the Friday session. One of the only green sectors in the market. Daily uptrend is nice and maintained right now. Your higher low is here, 212.82. I'll remind you, if we're still in longs or going for longs, this is the trailing stop loss level. Why? If we get rejected here, 232 down to 214, and sacrifice this or roll it over, then you know that any longs need to be paused and maybe reset lower, as the bulls will be looking for a weekly higher low, anything above 184.20 for a higher low. Then reposition for some longs potentially for a retest of the weekly resistance that we are still not through right now, but at least the bulls have a very nice uptrend. I myself will be waiting for some semi-weakness to reposition short puts under the market on some of my favorite companies, such as either, Qualcomm, Micron, NVIDIA, TSM, AMD, and anything that has ran nicely in the past few weeks. If you get a bigger, larger pullback that lasts for a week plus, maybe that'll be the time to load up on those credit strategies under the market. On to the Russell right now. The Russell down about 0.18 on the Friday session, but all in all, not looking too bad. Daily uptrend is still maintained. Looking for a higher low, anything above 195.37. Looking for a higher low, maybe for some trend continuation into the next line of defense, 208 up to 217. If they lose it, that will be a loss of the daily uptrend. Opens up the door for the downtrend and opens up the door as well for a little bit of weekly retracement. Good thing the bulls are in control. Anything above 181.16, looking for a higher low. Possibly for a second attempt at breaching through and going for the higher area of resistance. I would love to close this box green, but unfortunately with this weekly candle close, we just do not have enough separation for me to clearly say that this level has been captured by the bulls. Short-term timeframes, yes, but on the weeklies, no, you can get a bit of a pullback, which could see you head to the lower end of the range around 188. So just be mindful of that. It's a very wide and very congested area for those bulls. On to the Dow Jones right now. The Dow Jones also not looking too bad, down about 0.29. Healthcare has really been keeping this one muted, right? So right now, Dow Jones in the context of a daily uptrend, your higher lows are set at 40,750 roughly. Nicely, we have daily support down here, but same thing as IWM, right? We do not have a weekly candle breach. So although we are in a weekly uptrend right now, we cannot say, it's not clear, right? That's why I'm not turning the box green. They have not officially captured this, and these are weekly support and resistance levels overall. So in the event you lose the daily uptrend and the markets consolidate, you flush this guy, open up the door for the back test of resistance, and then flush. You'll be looking for a weekly higher low at this point. Anything above 37.8, we'll be looking for a higher low. Right, down into support 39,212, down to 38,000 roughly for a higher low, and maybe a second attempt at breaching this zone in the event the bulls run out of momentum right here. Now, in terms of our minor sectors, which we covered once on the Monday, once on the Friday, XLP doing a whole lot of nothing for the past few weeks of time. However, if we do come down a little bit more, I might just be looking to play some short puts into the entry location here, 78 down to 76.50. Very nice area of prior resistance to the all-time highs. Has proven to be support a few times over the course of the last few months, and any dip into there from value will probably get some short put orders from me and maybe even some swing trade longs. So I'll be paying special attention to that. Any swing trade longs taken from here, going for the weekly uptrend breakout. The stop loss is very clear, should be under 79.73. Keep that in mind. Moving on to XLU utilities right now. Utilities has been moving well, right? Moving very well. Weekly uptrend is now in motion for utilities. trying to crack above 80.4, but not quite doing it just yet. So any back test down here of 77 to 74 could be a very juicy entry point for maybe some short puts or some swing trade longs if you're looking to swing trade this industry overall. On to real estate right now. Real estate has also been a big factor of some recapture here in the defensive trade as they've recaptured a major line of defense, which is the 41.38 to the 39 level. I will gladly now change this box into green, which I did not do on the Monday, my bad. But now you can see they've recaptured it as support. And we're just looking for, this is a weekly downtrend, engulfing move, 100% retracement on this one. Any higher lows, anything above 36, looking for a higher low, maybe for some trend continuation. So special shout out to them and special shout out to the home builders as well, which are not looking too bad for a swing trade long with the stop loss below here and targeting possibly this guy right there. Decent little risk to reward factor, looking for maybe a recapture in price of the home builders. You're never quite sure whether they do a higher low and then flush, but definitely maybe a bounce opportunity out of this support range. Onto XLE right now. Energy still roughly flat, but trying to go for the daily uptrend break, coming out of resistance or rather support zone, which is 80.5 down to 74, and maybe into resistance. So you could see one leg higher, but if you're going for the recapture all the way to these range highs, the stop loss is very clear right now, 78.65 for a weekly uptrend bump. And if we fail, well, you'll know that we're going to head to the lower end of the price, which is the bottom end of the last 2-3 years worth of support. That is everything for your major sector recap. Hopefully you guys enjoyed that. On to the VIX right now. The VIX also moving lower down to 22, but I'll remind you, any unfavorable trade headlines whatsoever, any unfavorable macro releases whatsoever as well that point to an oncoming recession will make the VIX spike up a little bit more. So I'm not going to say that the VIX is dead forever throughout this year, guys. It can spike back up higher, so keep that in mind. So, right, if we're looking for credit strategies, selling puts and stuff like that, we know that after the VIX has come low like this, we need to be waiting for a spike in the VIX to really get the best possible levels. Essentially what I'm saying is if you're selling puts, can we please not sell puts super close to the market? When the VIX has been coming down a lot, when the markets have been bullish and looking like they're running a bit out of steam, focus on the big red days and the big negative headlines and the days where the VIX goes green. Moving on to the dollar right now. So the dollar saw some nice price action in the last few days, trying to set the daily uptrend right here, but we know it's into an area of resistance, a big one, 102.70 down about 100.7 as well. This 2-point range right here is a very big one, right? Although we have seen some participation back into the dollar, definitely not extremely bullish like it was at the end of last fall, right? So still some international players potentially still hesitant about getting back into the dollar. We'll see if that materializes into more bullish presence over the next few weeks, or if we get some more recessionary data, does the dollar value simply just erode again? That is something we're going to be keeping a close watch on, especially because it does impact something like gold or Bitcoin, which are expressions of the US dollar. How does that translate into yields? Well, yields have been doing absolutely nothing. Topsy-turvy action on yields, very difficult to determine where the price action is going to head. It's going to be all a question of government policy and trade deals and just sentiment, right? We know that the Federal Reserve is probably going to cut interest rates in July, and we'll get a more updated result for a summary of economic projections, which can move these in the month of June. We're still eventually looking for the drop-off on yields, but the distrust in the United States right now is high, and other nations such as China and Japan could possibly be offloading some of those US dollars to, artificially manipulate their own currencies to keep their exports competitive in the face of tariffs. So there's a lot of moving parts on yields, guys, right? All we have to say is that we're watching closely. 5% seems to be an area of contention on the 20 and a 4.5 on the 10-year as well. How does that translate into bonds? Well, bonds, TLTs, still doing a whole lot of nothing over the past 6, I would argue, the last year, guys, year and a half at this point for yields are for bonds, right? They've been doing nothing. Still a good area of accumulation if you have a long-term time horizon for a 20-year recapture, as rates will be coming down eventually, and that will cascade from the short end to the long end eventually. But when is that eventually? Tough to put an exact date on it, right? Moving into gold lastly. So gold, not performing too poorly here, but gold has been forming somewhat of an awkward trading range as it's come off the blow-off tops pretty much of very high weekly RSIs and very high monthly RSIs. May just be some time for consolidation on gold. What we're looking for here is a daily downtrend, engulfing move, looking for higher low right now. Anything above 3,200 looking for a higher low. When you put the fibs on this, which is my preferred tool for gold, you can see that is a 618 retracement. The bulls still do have a chance to make this move back to the longs happen. But if you're taking a long here, the stop loss has to be down below here, 3,200. Because if you lose that, you open up the door for daily downtrend and further weekly downtrend erosion here and monthly consolidation. So don't get too greedy on your gold trades. Definitely start trading with a stop loss. But the bulls still have a chance here at pushing incrementally higher over time. Moving into Bitcoin right now, we know that Bitcoin has been a very strong price action component here of the market, especially in the last week of trading. And Friday's action was a little bit muted, but we got a nice candle on today, Saturday, while I'm filming this. So daily uptrend is maintained and looks very nice right now. At this point, any move lower, anything above 93.3 is just looking for a daily higher low for possible further trend continuation. And I cannot say that we have moved over and above this big area of resistance, which ends pretty much at 105 all-time highs. We're looking for a weekly candle close into this area, which could possibly signal that maybe we have some more bullish momentum coming forward, as this is a seasonally bullish period in time for Bitcoin on a year-to-year basis, and the weekly MACD is looking like the bulls may just want a little bit more. If ever that is not the case, and we do consolidate into a daily downtrend, understand what the bulls are trying to do on the longer time frames. Weekly uptrend, looking for a higher low, maybe gather some more momentum and try to smash it again. But all in all, Bitcoin's looking good, and we know that when Bitcoin leads the charge, the altcoins follow. Tremendous weekly move on Ethereum, 40% to the upside. I was saying that I was accumulating a lot of altcoins at these lows. I'm starting to take a little bit of profit on those trades, but not everything. Very happy that it did accumulate. But, you know, I wouldn't chase the market with too much size. It's okay to position a little bit here, but just pay special attention to those moves on Bitcoin, because whatever Bitcoin does, the rest of the market will definitely follow. And that's everything for our major sector rundown and commodities and bonds and yields and all that stuff. Now let's move into big tech, shall we? All right, so moving into Apple first. Apple closing the day 0.53% to the upside in the green, and we're still looking for a new higher low. Anything above 189.84, looking for that higher low. Apparently it has been found, as the bulls were able to recapture throughout the day some semblance of a new hourly uptrend overall. So we'll see if that's the case, if they can maintain this higher low. If you flush that, beware, that is a daily downtrend. You'll be looking for support to hold up again, 196 to 187. If we are trading swing trade longs using this area as a stop loss and this area as a take profit, just be mindful of your levels overall. Apple is not looking too bad, but if we do erode, keep in mind who's in control here. The weekly bulls try to go for the uptrend, got rejected. We're right back down into support overall. And if you lose 190.31, unfortunately, that is a new weekly downtrend for Apple. And you may just be looking once again to the lower bound of support, which is down here, 178 to 162. If we do flush a bit more, I will gladly start writing some short puts in around that 200 weekly EMA. Below 180 is my preferred location for selling puts on Apple overall, as they continue to struggle with very low revenue growth rates overall and, you know, somewhat of an erosion of the iPhone market and still struggling with AI measures. But at the end of the day, Apple is Apple. There are always swing trades to be had on this company. Just do level to level swing trade action for now, as it's front and center in the tariff negotiations, right? Onto AMD right now, up 1.12%. AMD putting in some work. Got to give it to them, right? Putting in some work. So AMD daily uptrend right now, higher lows are set, 97.09 if we're in any swing trade longs. This is your new stop loss area, because if we fail and roll this over, well, you know that maybe we're looking for a bit of price action to the downside. Daily downtrend out of resistance, 112 to 97. And at that point, the weekly bulls will be looking for a higher low. At this point, we'll be looking for weekly consolidation, anything above 83.56, looking for a higher low, possibly for a new trend leg higher to breach this level. If ever they run out of gas, maybe need to reconsolidate a bit and go for a higher powered leg overall. The valuation, as we covered on their earnings recently, is still very cheap, very manageable, and they are growing into their long-term thesis of being able to provide more and more data center products over the next 2-3 years. Special attention goes out here to the MACD weekly cross, which is the first cross to bullish momentum in the last 6 months of trade. So you would not be surprised if AMD can surprise here to the upside and tackle the top end of that resistance range, but take it one day at a time and trade with your levels. Moving on to Amazon right now, 0.51% to the upside, looking quite good. Daily uptrend is maintained right now on Amazon. The higher lows are set right here, 183.59. Keep that in mind for your swing trades. Resistance highs stay put at around 206 will be the next big level in terms of your weekly time frames, yeah? So on the weekly, looking very good. Weekly trend expansion right now. And the higher lows, if ever we lose this daily price action structure and move a bit lower, we're looking for a weekly higher low, anything above 165, looking for that higher low. Possibly for some trend continuation. If we do dip down back into here, you guys know me, I'll be selling some short puts gladly into those fear low areas, as Amazon is one of my favorite big tech companies in the market. We covered their earnings and their earnings were largely fantastic. On to Google right now, still struggling with Google, right? Headline risk has always been front and center for Google over the course of what now? The past, 6 to 9 months at this point? Everybody knows the problem that Google faces right now. So moving on, daily downtrend, possibly looking for a lower high and lower low. So be mindful of that overall. Google price action has not been the most favorable. Even the bounce from this has not been too strong. So pay special attention. We are now trapped between two levels. 175 to 163 overhead resistance and below support, which right now stands at 150 down around 135. You can see clear loss of the weekly uptrend here by just this big bearish engulfing candle. I would not be surprised if Google can stay range bound as it irons out the details of its search business and advertising concerns. Right now, though, the stock is trading at a very manageable valuation. So if you are bullish on Google in the long term, it may not be a bad proposition to add right now. For myself, the way I'm trading this one is level to level. I'll be looking to sell some short puts under the market into fear lows, into the 2021 highs of previous resistance, which should now be acting as support, and your 200 weekly EMA is down there. On to Meta right now. Meta also down 1%, struggling, cannot close above 600. I've been pointing this one out now for 2 weeks of time, although Meta is still in a daily uptrend. You see the size of the legs, big leg, smaller leg, and now smallest leg, right? If you flush this one right here, 587, you know that your longs should probably be taking out at a profit as you are opening up the door to a new daily downtrend, as we have failed to breach above this resistance range. That would just be extended consolidation for the bulls. You'd be looking for a weekly higher low, anything above 480, looking for a higher low for possible further trend continuation, right? Just maybe coming back down into the lower bounds of support, which start at 530 down to 452. Tremendous long-term add opportunity for some portfolios and maybe another reload for some swing trade longs. On to Microsoft right now. Microsoft right now up 0.13% on the Friday session. Not looking too bad, right? Glorious move after earnings. Higher lows are set right now, but the higher lows are super close. 431.06. The weekly, all right, I'll give it to them, okay? It's not the most meaningful close, but it is a close above the weekly resistance range, which is now going to be support. All these boxes should be green. My bad. Let me just change them real quick. So now the bulls have support below us, right? But it's very close. The higher lows are very close overall, yeah? So if you lose this, right, and flush here, well, then you know that this area becomes resistance again, back test, and then the daily downtrend. That would be for weekly consolidation in these markets. Trust me, if the SPY and the QQQ go into weekly consolidation, Microsoft will follow despite being above this support range, yeah? So weekly uptrend is very nice right now, looking for a higher low. Anything above 355 on any extended drop would be looking for that higher low. This is the next area that I will be targeting for some swing trade longs myself, 410 down to 400 roughly, and also the next area that I'll be looking to sell puts in the market for my big account overall. Microsoft needs no introduction, one of the most solid tech companies of them all, and a great hold for a long-term portfolio. On to Netflix right now. Netflix down about 0.37 overall on the Friday session. Netflix very extended right now as we continuously deal with extended RSI, a somewhat curling over of the MACD. And as we can see here, the legs got a little bit smaller here, barely breaching the all-time highs, looking for a new higher low, anything above 1,107, looking for a higher low, maybe to push it up one more leg. But in the event you roll over with somewhat equal highs here and flush that low, that is a daily downtrend, and that will also be synonymous to weekly consolidation after a glorious 4 or 5 weeks worth of effort from Netflix. Maybe if you do see that daily downtrend, it's going to be synonymous with a few weeks of pullback. Not the worst for Netflix though. 1,050 down to 1,000 remains that area of support you're looking for, prior all-time highs, and the 12 EMA is going to be curling up there. Something like this would not appear too awkward for the stock, so that's what I would be looking out for myself as right now it is trading slightly rich in spite of its very, very attractive Q1 earnings that came out a few weeks ago. On to NVIDIA right now, 0.61% to the downside. NVIDIA as well, still in a long uptrend formation. So any longs accumulated at the lower levels, if you are riding, could be up for consideration for scaling out of the trade, progressively. But in the event you want to have a defined take profit, if you have a loss of a trend, that will be right here, 110.84, looking for a higher low for a possible continuation. If you give back the higher low and flush it, you open up the door for the daily downtrend and you open up the door for weekly consolidation. That's why I say that is your final exit price for a trailing stop loss. Weekly uptrend is still nice right now, but not quite breaching. I can't close this box green just yet. 115 down to 100 or 105 is that resistance range. Is it a clear break? No, so I'm not going to change it, right? Weekly uptrend is nice though. You need to understand that if you lose this daily price action here with the daily downtrend, looking for a higher low, anything above 95.48 is going to be looking for a higher low on the weekly. Maybe to try it again with more momentum. In the event you just keep going, well, obviously the next range of resistance highs is up here, 125 to 134 overall. NVIDIA not looking too bad, and they do have their earnings coming up in about 2 weeks worth of time. On to Tesla now, 4.72% to the upside on Tesla. Very good day for them. And I was saying this, right, over the past few days, if you're trying to trade a swing trade long on Tesla, be mindful, this area down here, 270 is the stop loss range. If you're entering at the bottom end of this range, that is the stop loss, triple bottom pretty much. And a tightening formation here of somewhat of a bull flag at the top end of a very nice move after earnings. Bull flag and break. Now you got the break above the 200 EMA as well. Could not close above that 300 psychological, but looking good. Now your stop loss still remains 271, and you would be targeting the highs right there around 361 for the take profit. Juicy risk to reward profile for Tesla right now. Seems that they do want to go for the overall weekly uptrend shift in the markets, looking pretty good. In the event they can get it done and just undo this entire move, getting rejected from resistance, which is still 300 down to 260, right? Just looking for a weekly higher low, guys. Anything above 224, weekly higher low, and then maybe you can find some new trade reset areas down in those lower positions overall. But nice little breakout by Tesla. Special shout out to the weekly MACD, which does appear as though it is flipping to the momentum side. Now, moving on to Palantir. Palantir down 1.55% on the Friday session, but recovering a very decent amount after their earnings drop, yeah? Daily uptrend was clear as day. We were saying after earnings that this is most likely looking for a higher low, maybe for trend continuation. If they cannot get it done and we breach this guy right here, 105.28, that will be a daily downtrend, right? So that would be the exit for any swing trades started at these lower levels, because that would be synonymous with weekly consolidation phases, right? At this point, anything above 66, looking for that weekly higher low. And the next big area of defense for the bulls is all the way down here, roughly around $97 to roughly $90 overall, in line with the 12 EMA and the most recent resistance, which is current support under the market. Curious to see, can Palantir expand and do the good old breakout, retest, and run? Or we just go into a bit of consolidation phase for the stock as it grows into its valuation and offering some decent trade opportunities down there. I'll be paying close attention to one or either scenario, but the price action still looking fairly strong on Palantir for the moment. On to SOFI, down about 0.6%. This one as well, right? This was due for some swing trade longs. Hopefully, if you guys were entering, now maybe you can set a stop loss here below 1244, because if you lose at 1244, guys, right, that's the loss of the daily uptrend. You open up the door for something like this, daily downtrend, into just an extension of weekly consolidation. We knew it was a weekly downtrend from here, right? Now they get the weekly uptrend back. And now just maybe looking for a higher low, right? Anything right now above 1040, looking for a higher low, maybe bounce back into the 1175.12. You know, weekly MACD is crossing, so a little bit of a week there would still possibly be synonymous with a long uptrending swing trade right there. And the take profits for those are within the $14 to $16 range, the closest area of resistance that we have here, which was also support from after the IPO phase of the stock. The valuation of the stock right now in the 13 range is still quite manageable, especially if you're in for the next 5 to 10 years of time. I like SOFI, and I have been building some positions for my long-term portfolios as well at these lower valuations. Moving on to Uber before last, 0.62% to the downside, recovering some of the earnings losses, but still going to go into a consolidation phase, right? The daily uptrend was very clear on Uber, with your higher lows now being set at 77.3. Any further consolidation from that is looking for a daily higher low, and overall also might just be looking for a, right? If you lose this, instead of daily downtrend, you got support below 80 down to 77. What you'd be looking for, though, is just a weekly higher low overall, yeah? Weekly downtrend engulfing move, looking for a higher low. anything at this point above 61. Looking for that weekly higher low for maybe trend continuation. If I see Uber for any which reason plow back into the mid 70s level with overall SPY QQQ consolidation, I'll gladly write some short puts down there and maybe even go for some swing trade longs. We did the valuation after earnings. It was still very manageable and arguably cheap, but obviously in the lower 70s is the perfect area for me. And now moving into the TSM, lastly, 0.74% to the upside. Opened up really high and then kind of gave it all back. Equal highs right here. Context is still the daily uptrend. Higher lows are planted at 170. In the event you cannot breach new highs into the following week, which would bring you, if that happens, up to 193 to 184 resistance range for the stock. If you cannot do that and get up into there, any swing trade longs should be cut with a trailing stop at 170.68. You breach that, daily downtrend, yes, it is into support. I'd agree. 171 down to 155. But the problem is you may just be looking for extension of that weekly consolidation, maybe to the lower end of this support range, 164 down to 156. This area right there, little pocket, looking for a weekly higher low, anything above 145. So on any weakness of this stock, extended weakness for a week or maybe more, I'll be looking to write some short puts under the market right there. And it may even open up some criteria for some swing trade longs. I'll let you guys know if that is the case. But as of right now, the bulls have not lost anything. I'm just preparing you guys in the event that they do. That is everything for our overall market rundown. Hopefully you guys enjoyed that. Now, in terms of new stocks, since next week is going to be a bit lighter on the earnings that we cover on a daily basis, I'll be going through a lot more stocks that a lot of these I've covered them through their respective earnings. So hopefully you guys have taken note of those. But I'll go through a bunch of stock opportunities that I'm seeing in this entire options list of over 100 plus different stocks, some of which I don't talk about often, but we definitely will run through a lot more of them now that we're through the bulk of earnings. I brought a lot of them to you during earnings, but just in terms of overall price action, some companies that I might be looking at that I don't mention too often on the channel, even though I do talk about them in these Sunday videos, the top 5 options plays. And I also bring up any new plays that I'm looking for in the Monday and Friday portfolio recap videos when I go through my own trades. That's where you kind of see stocks outside of the main list that I do cover overall. Speaking about the portfolio, let's get into some trade recaps, shall we? All right, so in terms of the portfolio for the week, guys, in terms of the trades, you can see that we did go perfect on our wheel trades right there. No closures of directional bets, so I'll update you on those when we go through the portfolio. And all the lottery plays, either earnings or directional, that we did take throughout the weeks in terms of short puts, they all expired pretty much either worthless or we were able to close them at some very nice profits all throughout the week. So very, very decent weeks in the past, roughly 4 or 5 weeks now, that we've pivoted kind of from the bull market strategy to the bear market strategy overall. Now, talking about that pivot in the art of transparency, as I always do on the channel, here's where we currently stand on the portfolio. We are still down 24% year to date. That is because, I'll remind you, back in the month of March, pretty much, I took a very heavy bet going in against sentiment right here. The sentiment was very atrocious, and I wanted to call the bluff. I was expecting 10% effective tariff reciprocal rates on the rest of the world. And as a matter of fact, when we came out with that news, before Trump showed the board, everybody was bullish. The market actually pumped in the after hours. Then when he brought out the board and showed us the highest tariff rates we've seen in over 100 years, that's when the markets really eroded here. And I was able to wind down those positions. I'll remind you, where we started off the year, where I've been running this account for 2 years with you guys over the past 2 years, right? 2023, I started. 2024 was the second year. During those years, I was running $100,000 and not really running much margin at all. This year, to show how to grow aggressively a smaller account, I started the year off with $46,000 for it's a bit more manageable, right? I have 2 accounts. I have this one that I showed to YouTube and another one that's roughly around, 500K for larger wheel trade positions, right? That one was fine. But this one I trade more aggressive in to show kind of what you can possibly do. But when you're trying to grow a small account, you kind of have to take on more risk. So leading into tariffs, I was pretty much full on margin. The plays weren't aggressive. What was aggressive was the amount of margin that I was running. And when I pivoted from the bull to the bear market strategy within these 2 candles pretty much, closed all the losses, pivoted the strategy with the data that we had, not knowing whether there was going to be a tariff pause or stuff like that, right? Long-term portfolio I was added to, but this swing trading account, of course, took a big hit. And I'm always transparent with my wins and my losses overall. You can see that in the past few weeks, we've done a very good job of recapturing a lot of those losses. We're underperforming the SPY for the year, of course, as we pretty much should be, because we were running 3-to-1 margin, right? And I'm very confident in my ability to turn this account around and bring it back into the green. I'll remind you, 2023, we had some great gains, 77% on this portfolio, made a lot of money. 2024, just with the wheel strategy, nothing fancy, right? It's not as if I'm all in call options. Just with the wheel strategy in 2024 and a few directional plays here and there, that was another 65% year overall. So back-to-back phenomenal years of over 3x performance versus the indexes. And now, you know, trying to run a bit high margin. It worked initially at the early stages of the market in the early year, and then we got hit with one of the fastest corrections we've ever seen. And that's when you saw really on the tariff day, everything started to decouple a lot, right? Going all the way down to 36%. Completely normal when you're running that amount of margin, but that's when you have to wind things down, pivot the strategy, and just trade things on a week-to-week basis and not really hold any swing trade longs for more than you can. So that is kind of an intro. I do this one whenever I show the portfolio for those of you that are new to the channel, but those of you who've been following, you guys kind of know where we stand, right? Very confident that we can recapture the 46K initial starting capital with this account. And overall, here are the current portfolio allocations, right? So you can see that I have a few short puts running for the following week, but largely I have full buying power going into next week. Affirm is one wheel strategy that I have maintained right now in the account for the upcoming week that was open on the Friday session. And even Shopify, we took a bit of a Shopify option after their earnings, and we got 30 cents for those for the 80 strikes overall. So I'm sitting here at Affirm 39.5s for Friday, and overall we're sitting at Shopify, 80 puts for 30 cents. Bear market strategy rules, as I show in my top 5 options plays for the Sunday sessions, of course. Now, overall, we have the same positions that I showed you on the Monday session. We added a tiny little swing trade on A-Lab prior to their earnings. It's not going the best, but we bet really small overall. Most of all the other bull call debit spreads that you see are directional bets, many of which are going well. Amazon, Bro, this is not Dutch Bros. This is actually Brown and Brown talking about the insurance corporation. Elf Beauty, we still are running covered calls against this one. We got a sign, a while ago on Elf Beauty, and we've been running some very juicy covered calls on this one overall. You can see here our assignment base on Elf Beauty is now down to 57.16. So we're already profitable, guys. So I'm just really making the most out of these covered calls right now in a profit. We have other bull call debit spreads, none of which are new. I've taken you guys through these many times overall. I'll be looking to ride these pretty much through the next few weeks of action there. That's kind of my swing trade longs. They're not that heavy overall. The biggest one is the Amazon Leap right there. And also shout out to the Micron Leap one as well, which are currently up 42% on overall. The Micron 2027 bull call debit spread. All the other ones are just small directional bets for this year. K-Web, I already took profit on one of these. I have another one. And we also have a small K-Web Leap, which unfortunately I was not able to build more. One contract is currently up about 10% right now. Nothing big, right? Other than that, all my cash is parked in SGOV, which I tell you guys to do at the end of every week. I'm cash on Monday, cash on Friday for all the wheel, right? Other than that, nothing else is really fancy here. Just the same positions that you guys have seen from me for a while now at this current time. And not too many wheel trades that I bring in or carry from the Friday to the Monday session either. Only Shop and Affirm overall. Everything else is just call debit spreads with a bunch of time either through July or August. Many of these I've already talked about in the last few weeks on the channel, so none of them should really be new to you guys. So we'll just kind of ride these and see what happens. But they're very small bets, these call debit spreads. They're always like 150 to like $200 each, right? Just going for those directional plays. That's everything for pretty much the portfolio recap as we try to recapture all those losses. If you're wondering, I'm the only one that went that heavy on margin in this. In the Discord, I'm very clear, right? I'm saying, don't trade on margin. I'm trying to do it to kind of showcase to the YouTube how you can try and scale a trading account quickly. But obviously, when you have corrections, you have to be fast and nimble on closing those losses. Because if I wouldn't have closed those losses very quickly, the losses would have actually been more substantial. So just, the losses are normal when you're trading on margin, on leverage. But the fact of the matter is none of the positions, you can even go back, none of the positions were in were actually risky. It's just I had a lot of them and everything got washed 20-30%. So my account did as well, right? So that's pretty much where we stand for that trading portfolio. I will do my best in terms of consistency to bring this account back up to par. No problem there. And in terms of the other portfolio, the small long-term portfolio that I've been kind of building out on the channel publicly right now, that's not the one. That's the dumpster dive portfolio. It's this one. So a lot of my members, because I also have a very large long-term portfolio that I've built since 2018, a lot of my members in the Discord wanted me to build a new long-term portfolio in this type of market. And I always provide the updates on that. Every single 2 weeks, I put in $300 to this account and buy some of my favorite names in the market. And I'll do this for the entire time that I'll have the YouTube up and running, which will be years into the future. Total invested so far right now is about $6,000. And as you can see right now, right, this account is not doing too bad. We're up roughly, well, you know, your return year to date is not too bad. And about roughly 3%. In terms of the positions, the most recent ads that I did, 2 weeks ago at this point were Amazon, Google, Elf, Meta, Microsoft, and TSM. $50 each. You can only do so much with $300 every 2 weeks. But I'm showing you guys, right? 10-15% of your paychecks. This is like an average for most people, right? Maybe $300 is a bit much for you. Then do 100 or do 150, right? A lot of you guys get free commissions. So there's no excuse. The positions that I've built so far are, I'll sort them by cost basis. So you can see my heaviest to the least heaviest: Amazon, Meta, Google, Elf, just looking for velocity of upside appreciation, Mercado Libre, AMD, American Express, TSM, Netflix, and Microsoft. Nothing fancy. Eventually, when this portfolio gets up to size, talking about $20,000, $30,000, that's when I'll broaden out to some of the more defensive plays. Your Costcos, your Visas, your MasterCards, your SPGIs. Several of those positions I have in my large portfolio, but this one, just to start, I target in my opinion, some of the stocks with the best velocity of growth in the short term, but I do complement, of course, with some of your legacy big tech names overall. I will be adding maybe a few names here and there to this portfolio as I see fit, but this has been the progression of it. And in terms of the, unrealized P&Ls overall, you can see which positions are currently down and which positions are currently up and by how much. So this, I'll remind you, I started this one not too long ago. The first week, of course, was the week of March 17th to March 21st. So I've been building this one all through the correction just to show, right, that it's a good time to start building portfolios in long-term companies that you really enjoy. And here's the average costs of all my positions as I've added to them throughout the past roughly about just about a month and a half at this current stage, right? So $300 every 2 weeks. We'll see how this one goes. So far, not too bad. So that's the recap of my portfolios overall. Hopefully you guys enjoyed that. And that concludes today's videos. If you guys enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing if you're new. We do these every Monday to Friday after the close, except for when I'm busy on Friday nights and Saturdays. Then I kind of do them Saturday throughout the day, like today. And of course, if you have any questions, always feel free to ask them down below in the comment section. I would love to answer all your guys' questions overall. Always a pleasure. And lastly, if you are interested in joining a trading community where you are also going to be able to follow a lot of the trades, a lot of the strategies that I run, whether it's for a small account, a medium account, a large account as well, because some are less aggressive and some are more aggressive. You can tailor them to yourself, of course, right? I'm not saying everybody has to copy the exact way that I trade my account. If you guys want my honest take from this, from all of our members, right? You might see my account down a lot because I'm overly aggressive with it this year, right? Specifically for the purpose of trying to go for utmost growth. Most of our members, through that entire correction, never really hit over from 8 to 15% drawdown because they weren't running 3-to-1 margin like I was, right? If you want to find a trading community that's focused on long-term wealth creation, either through trading accounts and long-term portfolios combined, well, you might consider joining our trading community, right? You get access to all my weekly trades overall, all of these trades, whether they're short puts or directional bets or leap call contracts or swing trades with shares, long-term portfolio builds. You get access to all of the weekly trade alerts. You also get access to our private morning live streams every Monday to Friday, where I trade live for about 2-3 hours in the morning and also take all your questions on your stocks, your options, your portfolios, both trading and long terms. And you can also ask me if you're not there, they're all recorded. You can watch them after that. And you can also ask me all your questions in our chat rooms all throughout the day. And I'm very active and very fast to answer any of your questions that you may or may not have. You also get access to my private videos where I show you different trading strategies that I do not publish that much on YouTube, and a lot of other videos such as technical analysis, how to grow accounts from small, medium, large, the allocation of strategies that you should best have within them, depending on your risk tolerance, of course, and many things of that sort, which have been providing members great value. And you get access to all my watch lists, all the technical analysis you see on the charts. You get to copy paste all my watch lists, all my charts, 2 clicks of a button. It really copy pastes onto your own trading view. And that also gives you access to all my fundamental analysis whenever you guys see, the earnings rundowns or any other, because I have this on like over 100+ different stocks, almost 200 at this point, right? You get to copy paste all that with 2 clicks of a button. It's super easy to do. So if any of that interests you, the link to the Discord is down below in the video description. And if not, I guess I'll see you back on the channel here, guys. Pleasure as always. Enjoy the rest of your weekend, and I'll see you back here tomorrow for the top 5 options plays video for the rest of the week. Take care. That's it for me. Enjoy it. And I'll see you tomorrow. Peace.